And if you look at the gold silver ratio, I mean, as we speak, it's 83.9 times. Now, when you bear in mind that the ratio, if you like, when silver was money was around about 15 to 1. And if you go back to Diocletian, it was 12 to 1, which is interesting, which is roughly the proportion, I think, of silver to gold in the Earth's crust. I mean, basically, what's going to happen with silver is that as gold goes up, and it's not so much gold going up, it's the dollar going down, silver goes up roughly twice as fast.
The precious metals market is undergoing a significant transformation, with silver emerging as a key player alongside gold's record-breaking performance. As gold continues to maintain its historic highs, silver's trajectory indicates a potential surge toward the significant $50 mark, a level not seen since 2011. Renowned economist Alasdair Macleod underscores the tight liquidity in the silver market, suggesting that even a modest increase in investor demand could lead to substantial price increases. He points out that silver has recently reached highs not seen since 2012, and if it surpasses the critical $32.50 level, it could quickly rise to $50 due to pent-up demand from investors who currently lack exposure to silver and gold. Recent market activity shows promising signs, as silver has consolidated above the $30 mark, establishing a solid foundation for future appreciation. A noteworthy aspect of the current market conditions is the gold-silver ratio, which Macleod notes stands at 83.9. This ratio holds historical significance, having previously been around 15 to 1 when silver was used as currency, occasionally reaching as low as 12 to 1. Currently, the gold-silver ratio is at 84.259, fluctuating between recent extremes of 85.308 and 82.224, offering valuable context for investors analyzing the relative value between gold and silver. In recent months, the relationship between these precious metals has become increasingly complex, with both markets experiencing notable volatility. This price action reflects a mix of technical factors, persistent inflationary pressures, and escalating geopolitical risks. As traditional safe haven assets, gold and silver exhibit heightened sensitivity to shifts in economic data and global uncertainties, making their price dynamics particularly relevant in today's market environment. Before we dive into this video, please subscribe to our channel, hit the bell icon, and share it with anyone who might benefit from it.
I mean, I would say that the investor demand for silver has actually been extremely low, not just in this country, but also elsewhere. I mean, we've had India has upped its imports hugely. Why? Because they're making solar panels. I mean, they're trying to compete with China. This isn't investor demand. The investors haven't really got in there yet. I mean, the idea that investors buy silver, if this was really true, it would be more priced as money than it is at the moment. It's just purely priced as an industrial metal. And if you look at the gold-silver ratio, I mean, as we speak, it's 83.9 times. Now, when you bear in mind that the ratio, if you like, when silver was money was around about 15 to 1, and if you go back to Diocletian, it was 12 to 1, which is interesting, which is roughly the proportion, I think, of silver to gold in the Earth's crust. I mean, basically, what's going to happen with silver is that as gold goes up, and it's not so much gold going up, it's the dollar going down, silver goes up roughly twice as fast because nobody's got it. It's a very tight market. And, the bullion banks are getting squeezed, something horrible. They are not quite as squeezed as much as they are in terms of the total market as they are in the gold contract, because in the gold contract, the mines aren't really hedging their position. Mine management, which actually has stuff which comes out, and they've got enough cash flow in order to pay the wages and all the other expenses, they're not going into the market and hedging the gold price. But when it comes to silver, a lot of them do, for the very simple reason that most silver doesn't come from silver mines. It comes from copper mines, from nickel mines, from lead mines, and gold mines. So you can see that this is silver, if you like, is something on the side, and you're not really interested in what the price of silver is. So what you'll do is you'll sell it forward into the market. So the swaps and bullion banks aren't, they're not in quite the same position that they are with gold. But that said, the liquidity in the silver market is extremely tight. And it's not going to take very much investor demand to drive it a lot higher. Now, I think I said earlier that silver, popped up and had sort of broke into new high ground. I mean, new high ground since 2012. This, I mean, the chart pattern under it is immensely bullish. I mean, make no mistake. This, once it clears the 32.5 level, I don't see very much to stop it going up to 50. So, that's just reading the chart. That's just reading the chart. And I'm not the only person who will be reading the chart that way. So you can see that we're getting pretty close to a position where there's likely to be an avalanche of demand by investors who do not have silver. And they don't have gold either, incidentally. I mean, the amount of gold that anybody owns is really very, very low on average. I mean, we're talking about what, 1% of portfolios or something. I mean, it's peanuts, when really you should be seeing an average of somewhere between 5, 10, and even 15% if you're really, sort of worried about the future. Where's that going to come from?
Recent commentary from Alasdair Macleod highlights the complexities within the precious metals market, particularly concerning gold and silver prices. He observes that profit-taking ahead of the weekend is a common practice, which has led to gold's decline from $2,685 to just below $2,650, and silver's fall from $32.70 to around $31.51. The precious metals market navigates interesting dynamics, especially in gold's performance amid broader economic conditions. Currently, gold is trading at $2,639, down over 0.6%. Nevertheless, it is on track to close September with gains exceeding 5.4%, marking its strongest monthly performance since March 2024, when bullion prices surged over 9%. Macleod further explains that hedge funds and traders anticipate a temporary strengthening of the dollar, which could result in a modest correction in gold futures prices. Importantly, these traders hold short positions on the dollar, reflecting their expectations of an eventual decline. This sentiment aligns with the US dollar's recent performance, which has seen a roughly 4% decline since July against a basket of major currencies. The dollar is now hovering near the lower end of its trading range, which has persisted since late 2022. Let's get back to the interview.
I think they're beginning to get really concerned about the outlook for the dollar, and the cut in Fed funds rate recently, 50 basis points, I think sent a very clear message that the Fed is now less worried about inflation and more worried about the prospects of a stalling economy, even though that wasn't said in the FOMC statement by Jay Powell. So on that basis, and also if you look at the chart for the dollar's trade weighted, there's something called a death cross, which is very, very bearish. Basically, what a death cross is you get the price underneath the moving averages, with the shorter moving average, in this case, we're looking at the 50-day, 55-day moving average, crossing down and accelerating now under the longer term 200, 250-day moving average. Now, what that tells you is that the dollar's trade weighted is very definitely in a bear market. And I think when the 100 figure, I mean, at the moment it's at 100.5 or something, when that 100 figure gets broken, I think all hell's going to get loose. So what the hedge funds, the pair traders are doing is they're anticipating this event. So this does give us the potential maybe for, if we get a little bit of a bounce in the dollar, perhaps you will see the gold futures values ease. So there could be a little bit of a correction, but I don't think it's going to go very far, because actually what these pairs traders are doing is they're not so much buying gold futures, but they're selling the dollar. Now, this is a very, very important distinction. That's what they have in mind. They don't want to have the dollar. They think the dollar is going down. And, they can go and buy sterling. They can get, which they have been. I mean, sterling's been pushed up to 134-ish, something like that. They can buy the euro, they can buy the yen. And the yen's had a good little run today, which has undermined the Japanese stock market. But the principal thing, because all those currencies have the same problem as the dollar at the end of the day, So the principal way out of the dollar actually is to just get the hell out of credit, which is what the dollar is, and go into real money, which is what gold is. And of course, silver with a gold-silver ratio, as I look at it at the moment, around about 84. This is way underpriced relative to gold. So, silver was breaking out into the highest levels since the middle of 2012. This yesterday, it breached the 32 and a half level. I mean, it's drifted back today, but do we take this seriously? I mean, basically, ahead of the weekend, there are always people who don't want to have open positions over the weekend. So, if you're short dollar, long gold, you've got a profit, what you do is you take your profit and you say, right, Monday's another day. And consequently, we've got gold, which has been as high as 26.85, I think. It's now drifted back to a little bit under 26.50. Silver from that peak, it got up to 32 and 70, I think, and we're currently 31 and 51. I mean, this is ahead of the weekend markdown, if you like, and perfectly normal, nothing to worry about. So that's roughly where we are. I think it's, the key points are that the demand at the moment isn't so much from the Far East or Asia. I mean, they're still taking out physical when they can, but I think the price drivers have really been the hedge funds who have woken up to the Fed's dilemma. And the Fed has chosen to, try and deal with prospects for a falling stock market, a declining economy, rather than tackling inflation. Inflation has not gone away. That is going to continue to be a big problem.
A complex mix of hedge fund strategies, currency fluctuations, and macroeconomic factors currently influences the gold and silver markets. Gold remains a resilient, safe haven asset despite recent profit-taking, while silver is on the verge of a significant upward movement if it surpasses key resistance levels. The US dollar's decline and expectations of lower interest rates favor both precious metals, enhancing their roles as hedges against currency depreciation and inflation. Is gold on track for another record-breaking surge, or will we see a pullback soon? Stay tuned to stay ahead of the trends. Don't forget to like, subscribe, and hit the bell icon for more updates on gold and the precious metals market.